The global economy continues to gradually recover from the pandemic and Russia's invasion of Ukraine, but it is not yet out of the woods. The COVID-19 health crisis is officially over. Supply chain disruptions have returned to pre-pandemic levels. Economic activity in the first quarter of the year proved resilient, and labor markets are quite tight in many places. Energy and food prices have come down faster than expected from their war-induced peaks. And financial instability following the March banking turmoil remains contained thanks to forceful actions by the US and Swiss authorities. Under our baseline forecast, growth will slow down slightly less than projected from 3.5% last year to 3% this year, a 0.2 percentage point upward revision for 2023. The slowdown is especially concentrated in advanced economies, where growth will fall from 2.7% last year to 1.5% this year. By contrast, growth in emerging markets and developing economies will remain stable at 4% this year and 4.1% next year. Now, this masks significant differences between countries and regions, with emerging and developing Asia growing strongly at 5.3% this year, while many commodity producers will suffer from a decline in export revenues. At the same time, global inflation is projected to decline slightly faster than projected in April, from 8.7% last year to 6.8% this year, a 0.2 percentage point downward revision. Now, stronger growth and lower inflation than expected are welcome news, suggesting the global economy is headed in the right direction. Yet growth remains low by historical standards, and while some adverse risks have moderated, the balance remains tilted to the downside, and it is too early to celebrate. There are growing signs that global activity is losing momentum. The global tightening of monetary policy has brought interest rates into contractionary territory. This has started to weigh down on activity, slowing the growth of credit to the non-financial sector, increasing households and firms' interest payments, and putting pressure on real estate markets. In the US, excess savings from the pandemic-related transfers, which helped households weather the cost of living crisis, are all but depleted. In China, the recovery following the reopening of its economy shows signs of losing steam, while there are continued concerns about the property sector. Second, core inflation, which excludes energy and food prices, remains well above central bank targets and is expected to decline only gradually. In advanced economies, core inflation is expected to remain unchanged at 5.1% this year, before declining to 3.1% in 2024. Clearly, the battle against inflation is not yet won. Key to inflation's persistence will be labor market developments and wage profit dynamics. Despite tight labor markets, overall wage inflation has increased, but remains behind price inflation in most countries. The reason is simple and has little to do with so-called greedflation. Prices adjust upwards faster than wages when nominal demand far exceeds what the economy can produce. As a result, real wages have declined. If labor markets remain strong, we should expect and welcome real wages recovering lost ground. Indeed, the gap between nominal wage growth and price inflation has started to close. Because firms' profit margins have grown robustly in the last 2 years, we remain confident that there is room to accommodate the rebound in real wages without triggering a wage price spiral. With inflation expectations well anchored in major economies and the economy slowing, market pressures should help contain the pass-through from labor costs to prices. Now, despite monetary policy tightening and the slowdown in bank lending, financial conditions have eased since the banking stress in March. Equity market valuations surged and the dollar depreciated further, driven by market expectations of a more benign path for US interest rates and stronger risk appetite. This provided some relief to emerging and developing countries. Going forward, there is a danger of a sharp repricing should inflation surprise to the upside or global risk appetite deteriorate, with higher borrowing costs and increased debt distress. Hopefully, with inflation starting to recede, we have entered the final stage of the inflationary cycle that started in 2021. But hope is not a policy, and the touchdown may prove quite difficult to execute. Risks to inflation are now more balanced, and most major economies are less likely to need additional outsized increases in policy rates. Yet it remains critical to avoid easing monetary policy until underlying inflation shows clear signs of sustained cooling, and we are not there yet. All the while, central banks should continue to monitor the financial system and stand ready to use their other tools to maintain financial stability. Now, after years of heavy fiscal support and rising interest rates, debt service is now increasing as a share of government revenues for both advanced and emerging markets. It is now time to gradually restore fiscal buffers and put debt dynamics on a more sustainable footing. This will help safeguard financial stability and will reinforce the overall credibility of the disinflation strategy. This is not a call for generalized austerity. The pace and composition of fiscal consolidation should be mindful of the strength of private demand while protecting the most vulnerable. Yet some consolidation measures seem entirely appropriate. For instance, where energy prices are back to their pre-pandemic levels, fiscal measures such as energy subsidies should be phased out. Now, fiscal space is also key to implement many needed structural reforms. This is especially important since prospects for medium-term growth in income per capita have dimmed over the past decade. The slowdown is sharper for low and middle-income economies relative to high-income ones. In other words, prospects for catching up to higher living standards have diminished markedly. At the same time, elevated debt levels are preventing many low-income and frontier economies from making the investments they need to grow faster, with high risks of debt distress in many places. Now, some of the slowdown in growth reflects the spillover of harmful policies. The rise of geo-economic fragmentation, with the global economy potentially splitting into rival blocs, will most harm emerging and developing economies that are more reliant on integrated global economy, direct investment, and technology transfers. Insufficient progress on the climate transition will also leave poorer countries more exposed to increasingly severe climate shocks and rising temperatures, even as they account for a small fraction of global emissions. On all of these issues, multilateral cooperation remains the best way to ensure a safe and prosperous economy for all. Thank you.